Welcome to the channel, guys. Today we're going to go in great detail and talk about the different types of investments. Now, wise investors know not to blindly put all their eggs in one basket. Instead, guys, they become familiar with a few different types of investments and use their knowledge of each to make money in different ways. When it comes to investing, there's a lot of baskets to choose from. It's important to understand all your options before you actually invest your money and start to build your portfolio. Each type of investment has its upsides and its downsides. The best types of investments to make in markets and a timeline to avoid capital gains. Among the different types of investments out there, there are probably a few that will work well for you, so let's get right into it, guys. The first one, without a doubt, is gold. Yes, you heard it right. You can invest in gold and other commodities such as silver or even crude oil. The practice of investing in gold goes way back, but that doesn't necessarily mean that it's a good investment. Gold is a commodity, guys, so its price is based on the scarcity and fear, which can be impacted by political actions or environmental changes. If you are investing in gold, be aware that your protection against a price drop is based on external factors, so the price can fluctuate a lot and quickly. The price tends to go up when scarcity and fear are abundant and down when gold is widely available. If you think the world is going to be a more fearful place in the future, then gold could be a good investment for you. At number 2, we have bank products and CDs. Bank products are investment types offered by banks that include savings account and money market accounts. Money market accounts are similar to savings accounts but typically earn higher interest rates in return for higher balance requirements. A CD or certificate of deposit is another type of bank product. When you purchase a CD, you agree to loan the bank an amount of money for a designated amount of time to earn a higher amount of interest on it than you would in a typical savings account. CDs are extremely low risk investments, but with low risk comes low reward. Most banks offer CDs at a return of less than 2% per year, which is not even enough to keep with inflation. At number 3, we have cryptocurrency. Cryptocurrencies are one of the newer types of investment. They are unregulated digital currencies bought and sold on cryptocurrency websites. Cryptocurrencies such as Bitcoin or Dogecoin have gained a lot of interest in recent years as an investment vehicle due to their quick and dramatic growth. They remain incredibly risky investments because of the many unknown factors associated with them, guys. There is a possibility of government regulations and the possibility that cryptocurrency will never see widespread acceptance as a form of payment. Cryptocurrencies currently have no intrinsic value and it could disappear as quickly as it came into existence. In the same way, you're able to exchange US dollars for any other currencies, but the question that one tends to ask is how to invest in Bitcoin. In the same way that you're able to exchange US dollars for any other currencies, you can also exchange your US dollars for cryptocurrencies. Cryptocurrencies aren't technically part of the forex market. The mechanics of investing in cryptocurrency is very similar. The hope of many cryptocurrency investors is that the value of those cryptocurrencies goes up against the dollar, and they are relatively simple to buy online. Someone who invested in Bitcoin in 2013 and sold it today would certainly make some incredible profits. The problem is that there's no way to time the cryptocurrency market. Bitcoin and other cryptocurrency could continue to dramatically increase in price, or they could drop to zero. The fourth is U.S. Savings Bonds and Corporate Bonds. When you purchase any kind of bond, you're loaning money to the entity you purchased from for a predetermined amount of time and interest. Bonds are considered safe and low risk because the only chance of not getting your money back is if the issuer defaults. U.S. saving bonds are bonds backed by the U.S. government, which makes them almost risk-free. Governments issue bonds to raise money for projects and operations, and the same is true for corporations who issue bonds. Corporate bonds are slightly more risky than government bonds because they're more risk of a corporation defaulting on the loan. Unlike when you invest in a corporation by purchasing its stock, purchasing a corporate bond does not give you any ownership in that company. An important note, guys, to remember is that the bond only nets you a 3% return on your money over multiple years. This means that when you take your money out of the bond, you're actually having less buying power than when you put it in because the rate of growth didn't even keep up with the rate of inflation. At number 5, we got mortgage-backed securities. When you purchase a mortgage-backed security, you once again are lending money to a bank or government institution, but your loan is backed by a pool of home and other real estate mortgages. Unlike other bonds, which pay the principal at the end of the bond term, mortgage-backed securities pay out interest and principals to investors monthly. At number 6, we have mutual funds. A mutual fund is a type of investment fund operated by a money manager who invests your money for you and attempts to get a good return. Mutual funds are typically made of combination of stocks and bonds. They carry less risk because your money is diversified across many stocks and bonds, guys. So you'll only reap rewards from stock dividends and bond interest, or if you sell when the value of the fund goes up with the market. When it comes to value, guys, remember that the mutual funds are built and managed by so-called financial experts who have a hard time beating the market, especially when you factor in the fee they're charging you to manage your money in the first place. Rule number 1, guys, to remember, investors expect a minimum annual compounded rate of a return of 15% a year or more. If you can get that, we don't care what the market did because we're gonna get retired in a rich way. At number 7, we have index funds. Similarly to mutual funds, index funds are one of the types of stock investments that diversifies your investments across multiple stocks. The difference between index stock and mutual funds is that the index stocks are passively managed, not directly overseen by a money manager. Because index funds are passively managed, there are less fee involved, which means you have the potential for slightly higher returns than a mutual fund, guys. Your returns will be based entirely on how well the index your fund is tracking does. Given that most major indexes are used to track the overall movement of the market, they perform about as well as the overall market does in the very long term. They tend to yield an average return of about 7% per year. While this isn't as high as the returns that you can achieve through successfully picking individual companies with the right research, it is a respectable return that is considerably higher than the interest rates of a savings account or the return rates of bonds. When you invest in an index, guys, you're essentially betting your money on the future of America. If you're confident that the American economy will keep growing, you're probably going to come out okay. The problem here is that if you put your money into an index and the country goes into a recession, the market could be down for a significant amount of time. That means your portfolio will be down, and if you're too close to retirement to wait for things swing back the other way, you could be in trouble. That's another plus of investing in individual companies. That's great ones tend to perform even in times of recession. So guys, whatever you invest in, remember, always do your research, because once you do your research, you'll be able to understand exactly where you need to invest. Remember guys, I am not a financial advisor, so please make sure to do your own due diligence before investing and never invest more than you're willing to lose. If you haven't subscribed to our channel, do subscribe to the channel and do not forget to press the bell icon. Share this video with your friends and with your family, and stay tuned for our next video. Until then, take care.